When you work and you receive an income, this income is called the gross income. We'll give it simple y. Let's assume that you receive $100,000 as gross income. This is the income you signed in your contract. Therefore, does it mean that you receive $100,000? Definitely not, because we have taxes. So let's assume that the tax rate is 30%. So this means that you will pay taxes of your gross income multiplied by tax rate. Therefore, 100,000 multiplied by 30%, it will be 30,000. So how much payment would you get after you pay taxes? So it will be your gross income minus taxes, and this is called disposable income. So disposable income, it means that's the income after tax, and we'll give it symbol YD. Therefore, in this example, our disposable income is gross income minus taxes. 100,000 minus 30,000, it will give us 70,000. So once you receive your income, what you're gonna do with your income? Usually you have two options. Either you consume or you save. Let's assume that your consumption rate is 90%, and we give it here little symbol C, or we can call it MBC. And then we have here for saving rate, it will be our little s, or we can call it marginal propensity to save. And as you see here, if our consumption rate is 90% and saving rate is 10%, so this C is called MBC, marginal propensity to consume, and the definition of MBC is for each additional $1 in income, how much you're going to consume. So MBC will be always between 0 and 1, which means for each additional $1 in income, you could either consume all of it, which is 1, or you could consume nothing and save it. It will be 0, or it could be any percentage in between. You could consume 90% and save the rest. Therefore, your MBC or little c will be 90%. The same for little s. It's called marginal propensity to save. What do you mean by marginal propensity to save? It means that for each additional $1 in your income, how much you're gonna save out of it. Therefore, our MPS or little s is always between 0 and 1, which means for each additional $1 in income, you could either save nothing, which is 0, or you could save all of it, 100%, or a percentage in between. You could save 10%, 20%, 30%. Therefore, we could say that our MPS plus MBC will always be equal to 1 or 100%. This means that if our marginal propensity to consume is 90%, this means that our marginal propensity to save must be 10%, which is 1 minus 90%, it will be 10%. Consequently, we have a disposable income, in this example 70,000, and we have marginal propensity to consume, MBC or little c, 90%. So what will be our consumption amount? Get MBC multiplied by 70,000. So it will be 70,000 times 90%. This will give us 63,000. What will be our savings? Our savings will be 10% multiplied by our disposable income. So 10% times 70,000, it will be 7,000. As you see here, our consumption plus savings must be equal to disposable income.